Hello and good morning, listeners. Welcome back to Almus Market Mornings, a daily dose of global financial update with me, Shikhar Garg. And before we begin, it's slightly delayed, but best wishes for Guru Purab to all. Coming back, we have an interesting turn of events and currencies this week, with the dollar under the hammer instead of being the hammer. A good gap down opening for USD INR, while other majors look to have also gained somewhat against the dollar. The discussions about a political gridlock from the US midterm elections affecting the policy changes are being held with a lot of market participants. So, JK, what's your take? What's moving the markets and the currencies? I mean, it's not just the currencies though. We have also seen the equities enjoying some bullish action after these kind of updates.
Yeah, good morning, Shikhar. Yes, it does look like a risk-on markets right now, as the investors seem to have discounted the peak Fed rate near 5%. Then prospect of gridlock after midterm election being viewed as positive, and history showing that the period between elections and the year-end gives positive returns. That apart, falling US yields were supportive, while a stream of good data from Europe giving hopes of other regions recovering helped sentiment. Reuters polls indicate also that the CPI tomorrow will be printing lower on most counts. Now, the election results will be known later today or by early morning tomorrow, the final, being some regions actually count a bit late. But that has not created any jitters for the investors. With 435 seats in the House and 35 in the Senate up for grabs, the midterm poll is happening at a crucial juncture for the economy and perhaps for the world as well. And we are going into a poll at a time when the economy and perhaps the world, is facing with high inflation, the Ukraine war, and the high rate prospects, etc., and also the slowing global economy. So I think if the gridlock results in the House or the US legislatures not being able to pass fiscal bills, that will make the job of Powell that much easier because the money or the liquidity-led inflation might be reduced, and he may not have to raise rates as much as thought. Yes, the dollar has taken the limelight in yesterday's trading, with the broad dollar index slicing through the much awaited or the much watched support at 109.50 and resisting a drop of more than 3% since Fed rate decision on Wednesday. All the major currencies had an impressive rally against the USD, including even the beleaguered yen, while Chinese ones gains have been muted due to reports of rise in fresh COVID cases there. Better data from Europe, the retail sales of Eurozone, industrial production in Germany, and the Centix index indicator, that's the investor sentiment. All of them came much better than expected, and euro having a maximum weightage on the dollar index and the euro moving higher actually helped the overall dollar index lower, and it dragged other currencies higher as well. Even GBP, which is still having structurally short positions in the market, have also tagged the euro higher, and falling US yields only added to the momentum, giving the usually docile gold higher by nearly 3%. At the same time, the two-year yields in Germany rose by 25 basis points after good data, leading to expectations of aggressive tightening moves by ECB, which has strengthened the euro. Besides, the market expectations are also, as I said earlier, for a moderation in US inflation figures that will be announced tomorrow. Broadly, I would say that the moves in the dollar have been led not just by the above factors, but also by the extremely skewed positioning in the market. So we see profit taking as we move towards the year end, and possible discounting of the peak rate by Fed and optimism of other economies doing better as well. Technically, dollar is at a very good support near 109.50, but a clear break could see it fall behind the 2% at least in the short term. Jury is still out to decide whether we have a medium-term top for the greenback. That will take some time to be clear, but we will take cues from the upcoming data, particularly the inflation numbers and the Fed approach based on that. Then yes, on the rupee, yes, definitely we had 2 days of gap down, and possibly we'll have a third day of gap down today, and that's possibly going to be a big hit for the dollar bulls who have been running, dollar buy positions for almost 10 months now. I mean to say that dollar INR has moved up for nearly 10 months. And this is one of the longest streak of gains that we have seen in the USD INR. And at last, the INR is seen responding to the moves in the dollar index lower. And this time around, it's been a staggering move of almost 1% yesterday in offshore market, where a high of 83.02 was also seen, and 82.02 was also seen, and then we saw a low of 81.21, and now we have possible opening below 81.40 and much lower than where we closed on Monday before we went into the holiday. Yes, I think just like the dollar index, the position speaks a lot here. I know that the fundamentals haven't changed much for the rupee. The deficits are still high, but what will probably drive it lower, the USD INR, is the pent-up supplies, and also the fact that exporters have held back selling for quite some time now because the dollar was in a steady uptrend, and also the for forward premiums had fallen. I think they all will be drawn into the market now that the dollar index looks much weaker, and also possible good flows into the market, so I think even the people who have been holding back, particularly the investors, may be selling on a stop loss basis because the technicals indicate that a move towards 80 in this run is not ruled out. So we have a very different climate for the USD INR now, suddenly in the last 2 days, and a sell-on rally would be the mantra, at least for now. Thank you.
Okay, wonderful. And yes, there has been quite a sudden change in the regime for all the currencies out here. But what I actually like to from the commentary was the fact that there was a good stream of data from the euro, which was somewhat supportive, along with the fall in the yields for the US. While there's another bit of concerning factor or concerning update was the fresh COVID cases in China, which has put concerns on the growth. Now, other than that, there was extremely skewed positioning along with the discounting of the peak rate for the US, which led for this kind of a move in USD INR and other currencies. But there's also, since markets are cheering a bit, there's also somewhat not so cheerful updates being found. One of them being the FY23 GDP growth may not exceed 7% as advised by the CEA, or the Chief Economic Advisor, Mr. Anant Nageswaran. Now, we are very proud of being associated with Mr. Anant Nageswaran, because he's been one of the panelists for the most sought after financial industry conference being held annually. And folks, it's nothing other than the Almus Rupee Money Conference, and we are back with another season, another round, another conference this December. Just hold your seats tight, and we shall be giving up further more updates on the upcoming conference soon. That's it for today, folks. Thank you so much for listening, and we shall come back again tomorrow with another round of updates.